and welcome to The Sage. I'm Paul Carlitz, CEO of Sagient in Los Angeles. I'm joined today by Andrew Marin, Esquire, to have a brief discussion on the basics of estate planning. We'll start with Andrew. Tell us who you are and how you got here.
I'm pleased to be here, Paul. This is very exciting. My name is Andrew Marin. I'm a California estate planning attorney and director of advanced planning here at Sagient.
It's interesting. We talked earlier about some topics being politicized. That seems to be a lot of what that's about, right? Not allowing the 1% of the 1% of the 1%, which controls some significant amount of our nation's wealth, allowing them to continue making that percentage even lower in their hands. I think that's what that is all about. Agreed upon or not is another story, but that seems to be what that was about. Leads us into a really interesting topic. We know what's being called the great wealth transfer is occurring generationally right now. Can you give us a feel of what that great wealth transfer is?
Yeah, it is. It's great, Paul. $84 trillion, 84, give or take, $84 trillion is going to be changing hands in the next 20 years. So a massive amount of wealth is going from the haves to the will haves. Mm-hmm. Something like 80+% of that money is going to be going to individuals, and the other percent is going to charities. That's what the idea is behind those figures. And what's interesting there is the planning that can be done in preparation to receive those funds and then planning to disperse those funds on both sides of the aisle. So again, for those that have an estate tax problem, it can be, how do I efficiently transfer my estate intact to the next generation? And it may be transferring assets into an irrevocable trust or buying life insurance to be set aside to pay for those estate taxes, because we can't just, the problem is not solvable. So I would say that, it depends on the situation and the circumstances, but taking advantage of the planning options that we have. Just to close on that transition of wealth, I would encourage anybody listening that may have, some sirens going off in their ears to consult with somebody about these things, Sure. Not leave it to chance. And then, unfortunately, the IRS might be an additional beneficiary looking for a handout at the date of death.
Well, it's interesting that we just hit that topic right after talking a little bit about gifting and giving, because one of the things we're seeing is baby boomers are increasingly leaning into the concept of giving while living, right? Passing assets on to their children now rather than leaving it to them in their wills. Obviously, there's a lot of nuance to that based on what we just discussed. I think there's a big piece of that is the ability to see my beneficiaries, children, grandchildren, or a charity enjoy or put to work what I'm giving to them. The idea of just my name on a building posthumously is nothing wrong with it, but the idea of seeing it happen and maybe having influence on it versus now it's out of my hands seems to be a big part of that transfer, which is nice. In addition, and maybe this is something you can talk to, is this might be one of the first generations not to do as well as their parents or the generation prior, right? So it's also a way to help them. You usually hear maintain the lifestyle that I'm accustomed to by a divorcing spouse, but a lot of parents who have done very well and are recognizing maybe their kids won't have, between inflation, the cost of living, the ability to make the same kind of money, they're not going to be able to live as well. And instead of waiting for them, maybe the parents live to 80 and now the kids are 50 and 60, if they can give that to them along the way, they can maintain the lifestyle they help them grow accustomed to, see them enjoy it, and maybe there's still plenty left over, or if there's not, it's still made its way to that next generation. Is that something you're hearing a lot from advisors and legal clients?
Yeah. More, I would say, than truly. It's fascinating to see how some of these things happen, and including in those points, I'm seeing quite often that we're having sort of a revolving door with clients where the kids are coming home after college because they majored in something that was emotionally enriching but doesn't produce that great of a paycheck in the future. So, pessimism, what it is, optimism, what it is. The dynamics of the future for somebody has certainly changed from where it was. And you're right, the parents are becoming more and more concerned for the well being of the future generations. So, to that, yes, what are they doing? And quite frankly, they're starting to give more and more to the living generation while they're alive. So we'll see parents that come in and they're no longer saying, I want to leave 100% to my kids. They'll say, I want to leave 80 to the kids, 10 or 20 to the grandkids, and 10 or so to the charity. So it'll be a combination of certain things.
It's interesting. The great wealth transfer, it's a real thing, right? And it's coming. I mean, you said it's in the next 20 years. That's not something that isn't tangible, right? Which is interesting. So how does one, so the children of the great wealth transfer, effectively the beneficiaries of it, right?
Mm-hmm.
How do they prepare to receive this? Like how should they be planning for it? Should they be changing their long-term plans? What are the tax implications? I mean, do they change their current investment portfolios based on potential dollars coming to them? I guess that there's a lot there, so sorry.
It's a great question. Let me try to unpack it. The first answer is to talk to your parents and to have a sense for what the estate looks like. I can't tell you how many conversations with clients that I've had or their children where there's a barrier between them for whatever reason it may be, but there's not access. Right. And so I would say for those families, there's probably a lot more therapy, that's needed to get to that point. And so if you can have that conversation, please do. At the very least, bring it up for them. Encourage them to have a conversation with other people instead of just leaving it there, and plead with them that, look, you'll be gone when this stuff happens.
Yep.
It's me, it's my, spouse or brother and sister, whatever the case may be, that's going to be dealing with this. So I would say encouraging them to do it. And for those where there is an open dialogue, pull back the layers of onions and see what's in there. You are increasing the amount that the family will be left with. And then, of course, for certain families, there need to be strings attached to certain things. A perfect example of this would be a special needs child. Now, that doesn't mean that the child was born with a birth defect. It could mean that they have a drug or dependency problem, or perhaps they have an overbearing, dependent spouse that might reach in and get access to those funds. Sure. So there's a lot of things there, and I would just kick it back to have the conversation, bring it up, because like we did when we said with the exemption, you use it or lose it.
Interesting. And how often are you seeing either the children or the parent saying, I don't want to work kids up. I have my own person. I don't want to work with your guy or gal. Or the parents saying, well, we've worked with so-and-so for 20 years and this is the person you're going to use. And how does that create conflict? Because I could see, I don't want to use mom and dad's person. He or she has been with them for 20 years. He or she may be retiring with them, or he or she isn't cutting edge, or these days, I think the big comment was they probably don't understand crypto like we do. Whether you like it or not is irrelevant, but right, they're out of touch with what we want. What kind of dynamic does that bring to the table?
So what we're seeing when these things play out is, kind of a changing of the guard, depending on the age of the parents, then the age of the children. So I would say as an initial response, go with what makes you feel good and where you're getting good advice. So if mom and dad's people are the right person to fill both of those positions, great. If not, then have a conversation and say, you know what, I want to perhaps get somebody else's take on this to see if it's the best solution forward. And then perhaps a child can introduce somebody that has a separate idea or perhaps wasn't presented by the parent's advisor. So yeah, I would say, kind of with anything else, tread lightly, see where you are, and then make informed decisions.
What are maybe 2, 3, 4, I'm sure you could go on forever, but we'll try and limit it, things that people are missing most of the time? When you catch up with somebody or they come to your office or you're working alongside an advisor and you're in that room, what are the 3 or 4 things mistakes that were made where if we're proactive, we get to lay the jacket over the puddle or the manhole so they don't step in it versus pulling them out of the manhole with broken bones and legs?
What a prudent question. I will say that in no order of importance, the number one thing that we see, or I just said no order of importance, so a top thing that we see is going to be the wrong people appointed inside of trust documents.
Okay.
So this is going to be a successor trustee that's incapable of doing the job, or a beneficiary that perhaps has passed away or is unable to inherit the funds for some reason. So we see that quite often. To the example earlier, perhaps a divorced spouse is still on there from 10 years ago because the documents weren't updated.
Okay.
Another thing that we see are for any gifting that we're making, gift tax returns are not being filed for any larger gifts. So as I had mentioned, we had discussed this year, you can give $18,000 to anybody else without eating away at your lifetime exemption of the 13.6. But anything above that, let's say you gift $1 million into a trust, you have to file a gift tax return. So many times those are not filed. And then sometimes the IRS can just absolve you. Sometimes they can make it a real problem.
Right.
So it really depends on those.
I don't think they're in the habit of absolving people if it creates revenue. We've been talking about this generational wealth transfer and the amount of money going from one generation to the next, and the need and the importance of planning, whether we said earlier estate planning or estate tax planning, right? One of the big horror stories we know in our industry is the story of the Miami Dolphins. So Joe Robbie was the owner of the Miami Dolphins. Upon his death, he hadn't done proper estate planning. His children, who inherited the Dolphins, his piece of the Dolphins, which was about 85% ownership of the Dolphins, had to sell their stake in the Dolphins, ultimately to Wayne Huizenga, for $109 million, which at the time, it's still a lot of money, but was a very deep discount to the value of the Dolphins. They did it because as soon as they received the $109 million, they had to pay $47 million of it in taxes, not for the sale, but for the estate taxes due from Joe Robbie. That 47 wasn't necessarily just taxes from the $109 million sales. It was to cover estate taxes because the estate was it was very illiquid, meaning the bulk of his assets was the Miami Dolphins, which is not a stock you can sell or cash in the bank or a life insurance policy like you've been talking about. Effectively, they were put in the position of a fire sale, right? Can you maybe talk to why that would happen? It would seem that type of an asset, which is pretty solid, and that type of wealth, these shouldn't be problems. But even at that level, whether you're worth however much he was worth or less, how does this happen?
Yeah, it's a great point to bring up. And I will say that this probably could have been avoided with proper estate planning. Really, the function here is, as you mentioned, illiquidity. So we don't have liquidity at the time that it's needed or liquid cash to pay for debts. And then a function of solving for that estate tax need that, as we mentioned, not everybody needs. So what happened effectively here was upon the passing, the family had to come up within 9 months the estate tax. Let's say it was 40%. You said the number was $47 million. That is a fabulous amount. And even if you have something like a sports team that's very profitable, the IRS doesn't want, as payment for estate taxes, part of the business. They only take cash. And they take cash within 9 months of passing. So the kids had to scramble to come together and figure out how to get the IRS paid, so the IRS didn't come in with their own agents and liquidate the assets themselves, basically sell off the company. So it's really a tragedy that, again, tragedy is
all relative.
Exactly. It's all relative here, but it certainly is a tragedy because, you can take a lifetime building wealth and then it can be lost in one transfer, in one generation, or here, one transfer with poor planning. So I would say in that situation, what could have been a tremendous opportunity for them would have been to have, of course, some money fall into the lap of the family at the time of the passing. Now, that could have been identifying some other asset or account, or, of course, having life insurance.
Okay. So I think the lesson there, and we're talking about obviously the 1% grouping again, but this concept of planning to avoid having to come up with the taxes like that in a short period of time isn't necessarily unique, especially when you think about in 2026, it's going to drop to 7 million, most likely. And you might not have been a titan of industry, but maybe you did well. You've been in a home for 20, 30, 40 years. A home you bought for 100, 150,000 in the right area could be worth $3 million, $4 million today. You're already coming right up on that estate tax threshold, let alone whatever other things you might have. Because when they value your estate, it's down to the Rolex on your wrist, right? Not just the bank account that they can look at. And the worst thing I would think one of the worst things, if you knew it was going to happen, that your next generation was going to be fire selling what you've built just to pay the tax for it, probably wouldn't leave people in a good mood. And it's wholly avoidable, as you've said, through foresight, planning, whatever. It's not always about implementing products, right? It's not always about buying life insurance or gifting something or buying something else. A lot of times it's really just about the process, right? The swing more than the clubs. And meeting with someone like yourself or any advisor, they're the people that will help you groove your swing or get your process down. And then ultimately, there may or may not need products to help get it done. So I think that's pretty telling. It's a nice way to maybe tie a bow on this with that. I'm sure Steve Ross is thrilled now because he's gotten the Dolphins after that, two generations later. But it just shows you that even the wealthiest people that everybody assumes have the best advisors and the best education and have all of this access, even they sometimes either it's a mistake or it could be hubris or it could just be, I'll get to it. And that's probably the biggest killer, no pun intended, of generation of just wealth and planning is procrastination. I'll get to it. It won't happen to me. And I'm sure you've seen that a lot.
If I had to say the number one thing, going back to that list that we didn't exhaust, it would be procrastination. It's people twiddling their thumbs, going back and forth, our office or somebody else following up, just is now the right time? Answer is no. And then unfortunately, we've had something happen to those people and the planning wasn't done. So avoiding that. And I'll take that conversation of having some sort of liquidity fall in the lap of heirs at a grieving time from sort of the 1% down to the 99%. And having liquidity at the passing of anybody is crucial just to pay for final expenses. I have seen, and I'm sure that you know as well, how expensive it is to have a funeral.
Yep.
To do certain things that are obligatory upon passing. And we've seen families that are, taking out loans to do these things because planning and liquidity wasn't set aside for passing. So I would say take action, protect yourself, protect your legacy, transferring it to the family. And there are plenty of ways to play defense and good offense, but it starts with assembling the right team.
So thank you, Andrew. I thought this was a terrific conversation. We clearly covered a lot of ground. And thank you for watching The Sage. Again, I'm Paul Carlitz, the CEO of Sagient, and this is Andrew Marin, Esquire, also of Sagient.